Welcome back to Financial Market Insights for Traders. I'm your host, Sophia. If you've been through the nerve-wracking roller coaster of proprietary trading, or you're planning to take on a funded challenge, this episode is especially for you. Today, we're talking about something every professional trader has to master to survive in this business: drawdowns. We all love the green days. Those moments when the market aligns with your analysis, you're riding trends like a pro, and profits are rolling in. But let's be honest, those aren't the days that test your discipline. It's the drawdowns, the red days, the bad trades, the what was I thinking moments that separate the amateurs from the professionals. So today we're going deep into how to manage drawdowns like a funded trader. We'll cover what drawdowns are, why they take so many traders out of the game, and more importantly, how to survive and thrive when your strategy hits a rough patch. Understanding drawdowns in prop trading. Let's start with the basics. A drawdown is simply the drop in your trading capital from a peak after a series of losing trades. And when you're trading with a prop firm, drawdowns aren't just psychological, they're contractual. Most prop firms give you two limits: a daily drawdown limit, meaning the maximum loss you can incur in one trading day, and an overall drawdown limit, the total loss you're allowed before your account gets shut down. Hit either one of those, and that funded account you worked so hard for, gone. No appeals, no do-overs. Why traders hit their drawdown limits? Now, let's be real. No one sets out to blow their account. So how does it happen? A few common culprits. Over-leveraging. You size up too big on one trade, thinking this one's a sure thing. Spoiler, it never is. Skipping stop losses. You let a loser run, hoping it'll bounce back. It usually doesn't. Revenge trading. You lose a few trades and get emotional, trying to win it all back in one risky move. Ignoring your own rules. You keep trading after hitting your mental stop loss for the day, thinking just one more trade. And that one trade pushes you over the edge. Lack of emotional discipline. You're letting fear, greed, and frustration dictate your trades. And listen, this isn't a lecture. We've all been there. But the difference between a prop trader who lasts and one who doesn't is how they manage those moments. Risk management techniques that actually work. So let's talk about what you can do. Here's what the top performing funded traders are doing every day to protect their capital. 1. Position sizing, the 1% rule. First up, position sizing. The pros typically risk no more than 1% per trade, and many go even lower to 0.5%. Why does this matter? Well, say you've got a $50,000 funded account. Risking 1% means $500 per trade. You'd have to lose 10 trades in a row to hit a 10% drawdown. At 0.5%, you'd survive 20 losses. It's not about how often you win. It's about how much you lose when you're wrong. 2. Set a daily stop loss and respect it. This one's simple but powerful. Set a personal daily stop loss and stick to it. If your prop firm allows a 5% daily drawdown, you don't get cute and risk the full 5%. You stop yourself at 3%. Why? Because that 2% buffer is your safety net. It keeps you from crossing the line if a trade gaps against you or if slippage kicks in. Think of it as a fire alarm. When it rings, you don't argue. You exit the building. 3. Scale down after losses. Let's say you've lost 3 trades in a row. What do most traders do? They size up. Try to make it back. And that's how you blow your account. Here's what you should do. Scale down. Drop your risk to 0.5% or even lower. Trade smaller while you regain your footing. Focus on execution, not recovery. Protecting your capital during drawdowns is what allows you to capitalize when your strategy starts working again. 4. Don't revenge trade, reset instead. We all know this one. Revenge trading is when you feel compelled to make up for a loss. It starts with "I'll just get back" to break even and ends with your account gone. So here's the fix when you feel that emotional tilt creeping in. Step away. Take a walk. Close your charts. Go do literally anything else. Because no good trade ever came from a panic mind. 5. Keep a trade journal and actually use it. If you don't know why you're winning or losing, you're flying blind. A good journal tracks entry and exit points, risk to reward ratios, trade setup logic, your emotional state before and after each trade. You'll start seeing patterns. Maybe you overtrade after lunch. Maybe your best setups all happen in the London session. Use that data to improve your edge and avoid repeated mistakes. 6. Only take trades with a 1 to 2 risk to reward ratio. This one's non-negotiable. If you risk $100, you should be targeting at least $200. With a 1 to 2 ratio, you only need a win rate of 40% to be profitable. That gives you room for errors, bad news events, and off days because the math is on your side. 7. Know and respect your prop firm's rules. Every firm is different. Some allow trailing drawdowns. Some have static limits. Some disqualify you instantly for a single breach. Read the rulebook. Know the boundaries. And never, ever assume you can get away with stretching the rules just this once. The secret to staying funded. Let me give you the real secret. It's not about hitting home runs. It's about surviving, preserving your capital, avoiding big mistakes, staying calm during losing streaks so that when your edge kicks in, you're still there to benefit. Most traders blow up not because their strategy is bad, but because they can't manage the losses. And remember, drawdowns aren't avoidable. They're part of the job. Your power is in how you respond. Closing thoughts. So here's your challenge this week. Review your last 5 trades. What was your risk per trade? Did you have a daily stop loss in place? Did you follow your rules? Or did you let emotion take over? Small tweaks make a massive difference over time. And if you're looking to join a prop firm that actually supports trader longevity, check out crystalballmarkets.com. Their broker-backed funding model includes built-in risk management tools, clear rules, and real opportunities for skilled traders to scale up. Visit the site, explore your options, and remember, your trading future depends on your ability to manage risk, not chase rewards. This has been Financial Market Insights for Traders. I'm Sophia, and I'll see you next time. Until then, trade with discipline, trade with purpose, and protect your capital.